Well, hello everybody, and welcome back to Trade for a Living. We're getting into trader tip number 11, and I'm going to talk about what is a parabolic SAR. And specifically, I'm doing this video for Mr. Eric Pope. He asked a question on our membership area over at tradesmartu.com, wanted to know a few details of how the parabolic is set up, and so I said I'll do a little video for you. So, quick little introduction into the parabolic. If you're not familiar with it, parabolic SAR is what we call it. It's created by a guy named Wells Wilder, and this system is initially designed as what we call a stop and reverse system. The SAR of SAR stands for stop and reverse. Now, if you're not familiar with a stop and reverse system, the way that the process would work in theory is you're 100% long, and when you stop out, it reverses your position, and now you're 100% short. And then when it stops you out, it reverses again. Now you're 100% long again, and on and on. Well, it works in theory, but in practice, it actually has some real challenges because of sideways moves. So if you get into a sideways market, it can be a problem. But aside from that, if you don't try to use it as a standalone system on its own, it's actually a really great system for helping to determine where your stop should be placed as part of a bigger trading system. So that's what the parabolic SAR is. Quick little introduction there. Let's talk about how it works. And the way that this thing is going to work is it's simply going to give you a location where your stop should be set. And the way it's going to identify that is it's going to start with the most recent extreme swing point. That's how we know where the current stop should be set. And then as the trade moves forward, the stop automatically will tighten. Now, this is a variation on a trailing stop, but the distinction here is the way that the formula is built together. And so the way that Wells Wilder did this is he created what's called an acceleration factor. And as the trade goes further and further in the right direction, the stop tightens up faster and faster based on the acceleration factor. And then when the stop hits the price of the stock, I should say, hits the stop point, it's going to stop you out, and then it would reverse you. So if you program this into a trading platform, it could do all the work for you. If you don't want to program it into a trading platform, then you can simply just put it on your chart and say, okay, that's the price point where my stop should be set. Let's take a look over here at a chart and see how the parabolic is constructed. So take a look if you can see it on this screen. I realize it's a little small, but we'll do our best to zoom in here. Notice that when we hit the price point of the SAR right here, the stop point, the dots flipped over and they came up to the top. Well, how do we know where this price is going to be? It's simple. That dot is in line with the extreme high point from the most recent swing high. And then every day, this stop is going to get tightened just a little bit. And as you get closer and closer, further and further into the trade, you see that the stop starts to tighten faster and faster. And that's where the name parabolic comes from. If you look over here at some of these others a little more developed, you can see how that curve starts to develop, and it starts to speed up the further it goes into the trade. That's where the term parabolic comes from, because it's more like a parabolic curve. So if you look over here at several of these, and let's just start with this one right here. On this particular day, we hit the stop point, and it flips the trade. So where did this dot come from? Well, it came from the most recent swing low point. That's where the dot is set. And so for the next day, that will be your stop. And then every day, this stop point is going to move a little bit higher and a little bit higher and a little bit higher until eventually what happens? Well, we finally stop out. The trade went higher and it pulled back and it finally stopped out. And at that point, what happens? Well, we flip the trade. So down here, we were long. Now up here, we're going to go short, and our stop is going to be at the most recent swing high point. And then, of course, you're into a bearish trade until we connect with it. At that point, we flip over. We're long. Go to the most recent swing low. There is the beginning of your stop, and then it's going to accelerate along with it. And so that's how these flips work. And if you can see on here, it's kind of hard to see, but if you can, I'll try to put a direct line from it here. You can see that that dot is actually 1 day ahead of the price point, and that's a good thing, because what that's doing is it's telling you tomorrow this is where the stop should be set. So if you look at this, you actually see it laid out here in Trade Navigator. that price point is $20.44. And so if you're in a bearish trade on this, your stop is at $20.44. And that's the way the parabolic is going to work. Now, is it a perfect system? By no stretch of the imagination is it perfect, but it is a good way to have a pretty good idea of where to set your stop. More often than not, it will keep you in the majority of a trend, and it will avoid most of the random stop outs that you typically will get if you don't have a good way to set your stops. So this is a great way to set your stops. It's a great possibility. It's not the only way, but it is a good way to do so. Now, one of the pushbacks that I get oftentimes, and specifically answering Eric's question that he was asking me on our website, a lot of times whenever you get these first initial parabolic stop set, it's got a long way to the stop. If we flipped into the bearish trade down here, you're going bearish at 1908 and your first stop is set up here at 2150 or above that. And so that's a pretty decent sized risk, and it does speed up as you get going. Well, the reason is because this particular move was a fairly volatile move. Okay, if it's not got a lot of volatility to it, then it's not going to be nearly as loose. For example, come down here to March, and you see we stopped out and flipped directions right here on this particular day. Well, that's not a huge move at all. We stopped out maybe around 1450, and then in this trade, the stop would have been set about 1350. And so it really just depends on where the current volatility is and where the most recent swing point was. If you do get into a trade like this particular one over here in May, and let's say the stop is more than you're willing to take, well, you always have the ability to adjust it yourself. And so perhaps you might want to, take one of these other swing high points, use that as your initial stop, and then when the parabolic catches up to it, now you start to track along with your parabolic. That is one way you could do it as well. But anyway, that's the way that the parabolic works, and that is why sometimes those swing points seem like they're really long ways away. Those stop points, I should say, because it is built on the swing point, and that's how it's all determined there. So if you like this and you want to learn some more, there's a few ways you can do it. Number one, you can subscribe to the Trade for a Living series here. You can check out some more videos in the program. You can visit us over at tradesmartu.com. If you visit us at tradesmartu.com, guess what? You have all sorts of things, all sorts of goodies. You can learn all about trading, got hundreds of hours worth of training on the subject of trading, all of the on-demand stuff that we've put together for you guys to watch. It's all available over there for one monthly price as a little membership over at tradesmartu.com. So just head on over to tradesmartu.com, or click on this button here for either a subscription to the Trade for a Living series or to visit tradesmartu.com. And until we meet again, happy trading to all of you.